Right, this is getting slightly serious. Jamie Dimon, who's currently the CEO of JPMorgan, just warned investors that the US is likely to tip into a recession in the next 6 to 9 months. And he suggested that the S&P 500, which is the global index that everyone pledged their allegiance to, may fall another 20%. Now, I know viewers here probably have a love and hate relationship with JPMorgan, especially those investors that have exposure to Chinese tech companies. So our history go way back. Recently, on top of Dimon's gloomy outlook for the United States stock market, an investment specialist under the asset management arm of JPMorgan commented on how the different geopolitical tensions, especially with the US and China, could supercharge China's innovation. And guess what? It indeed supercharged the entire basket of equities, at least to the downside. So I guess it's quite mystical of how Chinese equities react in lockstep to what JPMorgan has to say about them. So despite this love and hate relationship with JPMorgan, we can only love the like button here on YouTube. So better make sure you spread some love by smashing on it. Also, Moomoo is currently running a paper trading competition for charity. So this competition will end on the 21st of October 2022, and you can stand a chance to win prizes for being the top 100 winners. So on top of all these, Moomoo will be donating $1 to Make-A-Wish Foundation for every sign up to the competition. So just know that you're contributing to charity as well. So Moomoo has been a great partner for this channel and for my own investment journey thus far. I personally love the community feature of the platform. Sometimes I just want to kind of get a feel of the sentiments around a particular stock or a particular industry, and that's the easiest way to find out, to jump onto the forum to see what everybody is discussing about. So for those of you who don't have a Moomoo account yet, I don't know what you're exactly waiting for. For new users, you can get welcome rewards worth up to 190 Singapore dollars with your first deposit of $2,700. So I'll leave the link in the description box down below. For my US and Australian viewers as well, Moomoo is also running aggressive reward campaigns, giving out free stocks for different regions. Everything will be in the description below. So thank you Moomoo for sponsoring this video. Now, to quickly establish the ill fate that is binding Chinese stocks with JPMorgan, I believe many of you still remember vividly the day when JPMorgan claims that Chinese internet companies were quote-unquote uninvestable. And this happened earlier this year on the 14th of March. So to give them the benefit of the doubt, JPM did admit that the uninvestable call on Chinese internet stocks were published in error. But hey, with the benefit of hindsight, they should have stuck to their guns. And it does seem like, at least at this current rate, investors are giving up on Chinese stocks as a whole, and you can look at it from the entire price pattern itself. That said, when JPM made the call back in 14th of March, the following day was the temporary bottom before most of these Chinese stocks made a violent rally after Vice Premier Liu He's speech vowing support for economic growth and the capital markets. So what sort of support for economic growth and the capital markets? I guess people are still waiting for it. So for context, KWEB, which is a Chinese tech-related ETF, bottomed at $20.41 on the 15th of March and rallied to $31 the next day. So in the subsequent 6 to 7 months, there were not much emphasis placed on the entire Chinese internet sector, and KWEB was essentially consolidating in the same region, but at least it's kind of consolidating downwards. So just 2 weeks ago, Alexander Trees of JPMorgan Asset Management Division commented that tensions between the US and China has forced China to become a lot more self-sufficient. And he cited case studies such as the chip industry, especially the entire semiconductor kerfuffle required for electric vehicles, smartphones, 5G, and battery. So I think this is an increasingly worrying trend for many as this deglobalization idea takes place amongst the great power rivalry. So worse still, there will be a significant level of collateral damage along the way. And the chip export ban, which was instituted by the Biden administration just recently, is just one of such examples. So we will discuss the chip ban in greater details in a separate video because I do have exposure to Taiwan Semiconductor as well, but this is indeed exciting times ahead of us. Anyhow, Alexander commented that JPM has been investing in Chinese tech companies this year, and let us all welcome JPM to the Backholders Club. And let us observe a moment of silence. Anyway, interesting isn't it? Just 6 months back in March, someone from another division in JPM commented that the same stocks were uninvestable. But 6 months after, the same company is saying that they have been buying the same basket of stocks. How ironic. That said, I do give them the credit for standing by Chinese stocks in today's climate, especially when the narrative is slowly getting out of control. And just a side note, I'm getting many messages in my own DMs where fellow investors are slowly getting exasperated and slowly losing their patience in Chinese stock. So take my own experience for what it's worth. I'm not giving you financial advice. So JPM remains bullish on China tech because some of the firms have quote-unquote world-leading business models and a huge addressable market, while valuations are better than they used to be. So profitability has also improved because companies are spending less and being less aggressive against each other, partly because of probably the new regulations instituted to the industry as a whole. Wow, who would have thought? I wondered what was the pivotal moment between the 6 months when they had polar opposite views of the same matter. Unfortunately, due to JPM's impeccable record of having an inverse relationship with Chinese stocks, after the commentary of JPM remaining bullish on Chinese tech, KWEB went on to see 5 straight days of red candles, while testing the lows of $21 on the 13th of October, which is 7 days after JPM publicly endorsing their bullish position for Chinese tech. So for the record, correlation does not equate to causation. And the objective of this video is not to put down any company or any analyst working for them, but instead to shed some light on what I've learned from these experiences of making predictions. So for one, regardless of which company you are representing or how prestigious your title is, nobody has a freaking clue what and how the market will perform in the short run. I don't care whether you're an investment bank or whether you're just a retail investor. Sure, Jamie Dimon's opinion will probably be valued with much higher regard compared to maybe random people on YouTube, which is why there were tons of news headlines that broke the internet immediately after Dimon's comment of how the S&P 500 might go down another 20%. But it still doesn't denounce the fact that nobody knows with certainty of how things are going to play out. If not, they would probably have went all in as well. Bottom line is, it's a 50-50 chance. You're either right or you're wrong. Secondly, I love this quote from Charlie Munger. Show me the incentive and I'll show you the outcome. So let's be pragmatic here. When we hear so-called investment specialists of XXX company or CEO of XXX company providing a certain outlook of maybe the economy or even on their own businesses that they run, do you really think that they are doing it for the greater good of the public and it's their attempt to try to educate laymen like us to plug the information gap? Really? With zero agenda? I'll let you decide for yourself. Thirdly, many of these discussions around macroeconomics, it's probably good for keeping yourself up to date on what is going on in the world. But I find it quite interesting when more and more investors are incorporating macro directions into their investment philosophy. So for whatever that is worth, I have no idea how retail investors are trying to do it. I don't know how you guys are making sense of the myriad of contradictory data that is coming your way and how you are modeling the different set of circumstances and contributing factors that might or might not play out. But kudos to you if you have found a way. Do update me if it works though. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!